Welcome today to Student Loan Management. So this is our webinar as part of the Get Savvy, Grow Your Green Stuff webinar series about student loans, with student loan repayment, disbursement, all kinds of stuff. Because this is a complicated topic, we may go over the hour today. It is likely that we will because it was already complicated before, and every day it gets a little bit more complicated. However, we are recording this, obviously, so we will send the recording once it's captioned appropriately for accessibility to everyone that registered. So if you have to log off early, don't fret too much. We'll provide both all of the sources and information that we provide in the chat, as well as the slides and this recording to anyone that registered. My name is Andrew Pellegrini, and I run the Student Money Management Center out of University Bursar for the entire University of Illinois system. And I am joined today by my colleague, Nikki. Nikki, would you like to talk a little bit about yourself?
Sure. So my name is Nikki Jankola Shanks, and I am currently the policy director in the office of Lieutenant Governor Juliana Stratton.
Thank you, Nikki. So collectively, the Get Savvy webinar team represents organizations across the state of Illinois, which rest on the ancestral lands of multiple Native nations, including the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Ottawa, Sauk, Meskwaki, Kickapoo, Potawatomi, Ojibwe, and Chickasha nations. And we have a responsibility to acknowledge these Native nations and work with them towards a more vibrant and inclusive society. So we have a little poll that we like to do at the beginning of these webinars that gives us some insights on who's joining us. So all the polls move around, I feel, every time, but I just launched it. Hopefully the poll feature or window popped up for you, and you can kind of see that there's some basic questions. But if you don't feel like answering them, that is fine. But sometimes it gives us some more information on how to modify our examples or talk about what might be important for you to think about as you work through student loan repayment. All right, we have lots of full-time employees and students, as well as people from all age ranges, 25 to over 74. Lots of women on today, and a lot of diversity with ethnicity and race. So I'm going to end this poll now, and I'll briefly share kind of who else is joining us today. And I stopped sharing, but if you can still see the box, you can just exit out of it. All right, so our learning objectives are for today to address common myths and facts surrounding student loans. We're going to identify the types of loans that you have. Hopefully, we'll go over a little bit about student loans and all the different types that exist out there. We're also going to walk through how to know how much you owe and who you have to pay. Those are your servicers. Understand methods for managing student loans, of which there are many, and hopefully we can empower you with the knowledge to create a plan for managing student loans, regardless of where you are currently in the student loan management process. I mentioned at the beginning of this webinar that things are complicated, and they're more complicated now than ever. So I want to just put this disclaimer out today that we won't be covering all aspects of loans. So if you have a question about your student loans, contact either your school, your servicer, or federal student aid at the U.S. Department of Education if you have federal loans. And it's important to remember that any information, especially about federal student loans, changes pretty frequently. So what is discussed today during this webinar is current as of March 6th, 2025 at 12 p.m. Central Time. So we thought that was important to lay out. So this is kind of an overview, a very broad, high-level overview of the loan management process. So once you apply, either through FAFSA or for private loans, there will be a disbursement after you do jump through a couple hoops, right? It seems like most of you are probably in the repayment or close to repayment section of your loan management process, but it's important for us to acknowledge that, like, after the disbursement happens, which you do have to accept the loans before they disperse. And when you're in school, new loans are added to your loan portfolio each semester. And once you leave school, and that means when you drop below half-time, withdraw, or graduate, your student loans will go into repayment. And then you need to pay attention to like your 1098E tax forms. Those are the forms that are used to determine if you can deduct any interest from your tax liabilities. You also need to worry about repayment plans and tracking paperwork. And then once you get to a paid off point or forgiveness or cancellation, then you don't have to worry about this student loan management process anymore. We do want to highlight that there's a lot of uncertainty for federal loans right now. For example, the status of income-driven repayment plans is kind of unclear. We're going to talk about what we do know as of right now. The future of public service loan forgiveness is also unclear, partially because of the status of income-driven repayment plans being unclear, and budget reconciliation may impact the future of student loan disbursements in general. So we just want to put that out there. It's kind of a glim look at what our future holds, but we want to be transparent about what's going on with federal loans. All right, I'm going to hand it over to Nikki to talk about some of the myths or facts related to student loans, which we'll be using the chat for.
Hello. All right. So just kind of wanted to go through some of the things that we're hearing. As Andrea mentioned, you guys can type true or false or myth or fact in the chat as we go through them. So let's go ahead and start with the first one. You can get your student loans canceled if you file a FERPA violation complaint against DOJ. Anybody know that one? Don't see anybody guessing anything in false. No
Yeah.
clue. Fair.
The reason that we mentioned it is because it's been a popular thing going on social media. So we felt we needed to address this myth.
Yes, it apparently went viral on TikTok. So, all right. So let's see, Andrea. There is no loan forgiveness from FERPA violations. FERPA stands for Family Educational Rights and Privacy Act. The enforcement of that act is not from the Department of Education. I'm sorry. The enforcement of that comes from the Department of Education itself, not private lawsuits. So you can't sue using FERPA. If you feel that your privacy rights have been violated, you can file a complaint with the Department of Education, but just filing something under FERPA is not correct. That's not going to just automatically get your loans forgiven. And as we said, this was going viral on TikTok, so we wanted to address it. All right, if you don't graduate, you don't have to repay your federal student loans. Is that a myth or a fact? All right, I'm seeing lots of answers there. Yep. Go ahead, Andrea. It is a myth that you don't have to repay loans if you don't graduate. Any type of loan, whether that's federal, private, or institutional, have to be repaid regardless of whether or not you receive a degree. All right, myth or fact, it's easy to get your student loans discharged in bankruptcy. Myth or fact?
It seems like we have a pretty knowledgeable group of attendees.
Yeah. All right. Private student loans, yes. Government, no. Myth. All right. So bankruptcy discharge is not a good plan for handling any type of student loans, whether that's federal or private. It is incredibly hard to discharge student loans in bankruptcy. It is not a normal bankruptcy declaration. The bar is significantly higher. So it is a myth in terms of that. Very rarely is bankruptcy discharge granted. Right, refinancing your loans does not give you access to federal repayment options. Is this a myth or a fact? Got one answer. All right. We got pretty even split here. So it is a fact. Refinancing is only for a private loan. So if you refinance your loan, you are no longer eligible for anything related to federal repayment or any type of federal programs, repayment options, etc. And we're going to talk a little bit more about refinancing in a couple slides. All right, and our last one. If the Trump administration shuts down the Department of Education, I won't have to pay my student loans. Anybody? I see one myth there. Yeah. So go ahead, Andrea. That is a myth. If there are rumors circulating that they are getting ready to put an executive order in place to shut down the U.S. Department of Education, that means that student loan debt would likely, again, no guarantees because this is all rumors at this point, but that part of the Department of Education's portfolio would just be moved to the Department of Treasury. So borrowers would still be required to repay their loans. It just means that if that does happen, make sure you're keeping an eye on any sort of communications regarding where your loan is at. And now I'm going to turn it back over to Andrea.
Thank you so much, Nikki. So let's talk about, based on where you are in the student loan management process, how to keep your student loans organized. So the guiding questions to get things organized, if you haven't before, is to understand how much you owe, what types of loans you have, and who are your loan servicers, because your servicers are who you're going to be contacting if you need any adjustments to your situation, if you're going to be late, if you want to see what your options are for repayment. So those are very important things to consider. So depending on the type of loan you have, you can go get information about your loans from studentaid.gov. That's for federal loans. Your school, if you have campus-based loans, or if you have private loans and you don't know who your lender or servicer is, you can go to annualcreditreport.com, and you should be able to pull your credit reports from Equifax, Experian, or TransUnion to see where your lenders might have reported your loan balances. And that's where you want to, those little sources are where you want to look for student loan balances, the interest rates, and again, those servicers, which are very important. So you can think of the types of loans as going into three main categories when it comes to repayment options. There's federal, institutional, or private. So direct loans are the only type of federal loans available currently that are still being dispersed, but they come in a few different flavors. So there's direct subsidized, which is for undergraduate students with financial need, direct unsubsidized, which is for either undergraduates or graduate students without financial need. There's direct plus, which is for either graduate students or parents of undergraduate students and is based on credit. So there is a credit component even for some federal loans. Or direct consolidation, which allows you to combine different types of federal loans, like maybe you had a federal family education loan, common called FFEL or FEL, and then went back to school and you got some direct unsubsidized loans, and now you want to combine them to qualify for different repayment options and maybe simplify managing your loans. Institutional loans are dispersed through your school, and there have been a few unique campus-based federal loans that fell in the institutional loan bucket, but are actually federally seeded loans. So you have access to federal repayment options if you have one of these types of federal loans. So these include the now retired Perkins loan and the health professions loan, which is still being dispersed. Then there are also private loans, and the repayment and qualifications vary by lender for private loans, which we'll talk more about how to compare those options a little bit later. But we do have another poll, if I can get it functional. Poll disappeared. Well, if you have I see some people are putting in the chat, you have only federal, you have a mix. If you have private or institutional, or maybe you're unsure, and that's okay if you're unsure. That's why you're here, so you can learn where to look for and how to identify what types of loans you have. If you don't feel like sharing, that's fine. I can't find the poll, so let's move forward. So if you're seeking a loan either through FAFSA, the free application for federal student aid, or a private lender, there's a few things you need to do. You need to complete the FAFSA first, many scholarships even, and even some private lenders may require this before they'll process your application. You also want to look at your credit history, like through annualcreditreport.com. You want to talk to potential co-signers if you need them, especially if you don't have much credit or any credit. You want to make sure to apply and compare private education loans in a short time frame so it limits the impact on your credit worthiness. So it's really important when you are applying for any type of private loan that you are applying in maybe just a few days rather than doing maybe a few a month or over the course of several weeks, because the credit inquiry that ends up on your accounts, the reports will just be one based on the type of credit that you're inquiring about. So it'll be one for all the education loan applications that you filled out during 2 days. And then that allows you to compare things like your interest rates as well as your terms. So those are important things to keep in mind if you're seeking any federal loans. So when it comes to comparing private loans, that's a little bit different than what you would be able to do or even think about with federal loans. So you want to look at what are the requirements to qualify for this loan? Will you need a co-signer? Because sometimes lenders are upfront about needing a co-signer or not. What are the interest rates? If they are fixed, this remains constant throughout the entire term of the loan. If it's variable, it will fluctuate based on usually an index. So you need to be mindful of what type of interest rate that you have with whatever loans that you go with. You also want to ask, what's the administrative cost? This is origination fees. Even federal loans have origination fees. So it's important to compare the cost of those origination fees across private loans. You also want to consider, when does repayment start? Depending on the type of loan it is, especially for private loans, it may start immediately after disbursement, even while you're in school, or there might be a in-school deferment similar to what there is with federal loans. And then do you also want to ask, do you have options for repayment? Like, is there a grace period after you graduate or leave school where you can try to find a job before your first payments due? Is there anything like forbearance or deferment if you were, for instance, to get sick or get deployed if you're in the military, or for whatever the case may be? Are there late payment penalties, and how much are they? Are there early payoff penalties? Those are all things that you want to consider when you're comparing private loans. All right, so we're going to walk through an example where you're comparing different types of private loans. So what you can see is we have 3 different loans here. There's lender A, lender B, and lender C, and they all have different names. These are all fake names. So if you try to Google these, hopefully there's nobody named Fixed Future Bank or EduFlex or SmartLend. We made these up, but they have different interest rates and different types of interest. So the lender A has a fixed 6.5% interest rate. Lender B has a 5.2% variable, but it can go up to 10% depending on what the index says at whatever time frame that you're making payments. And then there's a fixed 7.1% interest rate on lender C, SmartLend. So the origination fees for lender A, they cover it. There's none of them. That's really great. The origination fees for lender B is 2% of the loan amount, which is kind of high. And then lender C, it's 1% of the loan amount. So that is the upfront administrative cost of distributing the loan, which again, direct loans also have. The repayment term differs between these 3. The first lender and lender C have a 10-year repayment term. So you have to make all your payments within those 10 years. And then lender B has a 15-year term, which will also increase the total cost of the loan. For in-school payment situations, lender A provides an option where you just make interest-only payments, which can reduce the cost of compounding interest. Lender B allows full deferment, but that means that the interest is probably going to accrue while you're still in school, so you'll have compounding issues. And lender C, interest accrues and full deferment is allowed until you graduate. So it's important to remember all those pieces as well. The other thing is if you don't have a cosigner, it limits what options you have available to you. So if it's lender A, you only need a cosigner if you have less than a 700 credit score. And we don't know which of the credit scores that they're pulling for this. They could be pulling FICO, they could be pulling Vantage, they could be pulling some proprietary score for that some other company creates, because credit scores are very complicated. For lender B, it's required for everyone. So if you don't have someone that will support your educational journey or has the credit worthiness to be able to co-sign and get you a loan, that's not going to be an option to you. And lender C, there's no co-signer required, but it also has the highest interest rate. So that's something to consider. There is a cosigner release option for lender A and lender C, but only after you make so many on-time payments. And there is a forbearance option for lender A and lender B, but only for 12 or 24 months. So these are all really complicated aspects of comparison, but this gives you an idea of what to look for and what might be limited to you as far as access goes based on who you know and what your socioeconomic status is or how high your credit worthiness is. So those are all complicated aspects of private loan comparison, but hopefully this gives you kind of a template to work from if you have to compare private loans. So after student loans have been dispersed, there are different aspects of management that you need to pay attention to. So while you're in school, you obviously want to track and manage your loans. You want to know what you were offered, what to accept or what you have accepted, and make sure that it's been dispersed. You can also cancel unneeded loans if you don't need them, obviously, or you don't anticipate needing them. So you can reduce the costs by returning excess funds through your school, which reduces the origination fees because it's a percentage of what's been dispersed to you in the same, I believe it's semester. So you could also reduce the amount that you accept up front, and if you need more later, you can go ask for more that you were offered. So that's something that you can think about for reducing your overall loan indebtedness while you're in school. Just because you're offered it doesn't mean you have to take the whole amount out. The other thing, especially for unsubsidized student loans or most private loans, is you want to consider making early payments because interest accrues on unsubsidized loans while you're in school. The compounding of interest can increase your overall cost of the loan when you go to start repaying. All right, so if you're leaving school or going part-time, you also want to make sure you have all your contact info updated. You want to keep your federal student aid dashboard and school records current so that you can be contacted if something goes awry or if your servicers change, for example, especially for federal loans. You also want to know your loan details. I keep mentioning servicer because it's very important you know who your servicer is, who you have to pay when it comes to repayment. You also want to know and keep track of your balance and the repayment terms that you are eligible for. That's its own thing, and we are going to talk about repayment explicitly for quite a bit of today's webinar. You also may need to complete exit counseling. This is required for federal loan borrowers, so keep that in mind. And you want to check what your grace period is. You want to know when repayment begins. Once you enter repayment, you still need to keep payment records and keep track of your balances, even if you are signed up for automatic or ACH payments. You also want to understand what forgiveness programs are in place. You need to follow those requirements very closely and know your rights related to them. There's, especially with public service loan forgiveness, the first group of people that were eligible for it had to submit appeals and records for months before they got the remaining balance forgiven on those loans that they had already paid on for 10 years and worked in public service to be able to qualify for. You also want to explore deferment or forbearance options because those exist when you're struggling. For instance, if you're going through cancer treatment or you're sick or you have a situation where you're taking care of family members and unable to work, you have options to help you navigate those situations where you may be struggling financially. And again, knowing your rights to protect yourself from both mistreatment by servicers as well as fraud, because there's a lot of people out there trying to make money off of the student loan repayment process and its confusion. So 2 things around taxes that we just wanted to mention. While you're in school, Form 1098-T can help you identify if you qualify for the American Opportunity Tax Credit or the Lifetime Learning Credit. And while you're in repayment, Form 1098-E allows you to deduct up to $2,500 in interest payments towards student loans. So that is just payments towards interest, not towards your principal. And Form 1098-E is provided by your servicer to track how much in interest that you paid throughout the calendar year or tax year. So those are things that are very complicated, but we gave you a lot of information to keep in mind. And I'm going to hand it back over to Nikki now.
All right, so we're going to start talking about what happens during repayment. And this is where recently there's been some changes. So we're going to do our best to guide you. All right. So grace period. When your repayment, it's not like you are finished with school and repayment starts that first month. Typically, it's 6 months for direct loans or federal family education loans. It is 9 months if you still have Perkins loans, although those are starting to be a little bit more obscure. So typically it's likely 6 months before you have to start repayment. However, if you have a private, that is for federal loans. If you have a private loan, you have to check, just like in that slide that Andrea went through, when you need to ask your private loan officer, like, when does repayment start? Because it could be immediate with a private loan. All right, so what are your repayment options for federal loans? Again, there's been a lot of recent court cases on this, so we are going to kind of break this down. The three clearest pathways towards repayment is the standard, graduated, or extended payment plans. Currently, all three of these should be available to you. The standard plan is also the default payment plan for borrowers. So if you never select anything and you're already in repayment, you are most likely on the standard repayment plan. That basically takes your entire loan balance, divides it by 10 years, divides that by, so you're paying a monthly fee that will pay off your loan in 10 years. A graduated repayment has lower monthly payments when you first start paying, and then they go up, the payments go up incrementally every 2 years until you've paid off your student loan, which they'll calculate off of 10 years of payments. Extended repayment lowers your monthly payments by spreading out payments over a longer period of time, so 25 years. So it's the same thing with graduated, but it's just kind of giving you, instead of it based off 10 years, it's basing it off of 25 years. Now, income-driven repayment plans. This is what has been in the news a lot lately. It is important for us to emphasize that currently in this moment, like right before we started this webinar, we checked all of these options are currently inaccessible. However, we want to go through why that is. Some of you guys may have been on some of these, so you need to know what's happening. So first, save or repay. The save or repay plan was completely blocked by federal courts, which means it is no longer allowed and it is no longer an option. For those of you that were in or on a save or repay plan, likely your account went into forbearance automatically, but that may be something you want to check. In this moment, pay as you earn, which is pay, or income contingent, ICR, they are payment plans, but they are no longer eligible for any type of loan forgiveness. So in the past, it was like, oh, if you pay on this loan for 20, or using this repayment plan for 20 to 25 years, the rest of your balance is forgiven. That is, you may in the future be able to still pick those repayment plans, but they can no longer be eligible for any type of forgiveness or cancellation. Then there is the income-based repayment plan. This plan was designed by Congress, so it should be available. However, it is currently not available on the ED website. So that is something to keep in mind, that if you want that particular plan, you're gonna have to keep coming back to the studentaid.gov to see when that becomes available again. We are gonna talk a little bit more about public service loan forgiveness. Being on public service loan forgiveness means you have to have, you should be on the income-based repayment plan in order to have your loans forgiven after your public service, after serving in public service for 10 years. However, right now, there is no way that unless you were already on an income-based repayment plan, there is no way to currently get on that plan. I know that was very confusing. It's confusing to Andrea and I as well, but we just wanted you to hear that. So basically, save and repay, totally blocked, no longer allowed at all. Pay as you earn, or income contingent, ICR, The payment plan itself may be available. However, there is no, you cannot receive forgiveness using those plans. Any type of forgiveness, public service loan forgiveness or anything. An income-based repayment plan should be available. It's just currently not. And that is the only option for any type of forgiveness or cancellation through public service loan forgiveness or anything like that. So that is where we are. One thing to note that we're talking about, you are not entitled, if you have a private loan or an institutional loan, you are not entitled to any federal repayment or forgiveness options. You cannot apply for public service loan forgiveness. You cannot apply for income-based repayment. You have to talk to your private loan administrator for anything related to your private loans. All right. So how do you find the best repayment strategy? There is a tool on studentaid.gov called the Loan Simulator. It's on there. It gives you an idea. It's not like a guarantee if you go through that, like this is what your payment will be, but it gives you an idea of, you put in your personal information, like what is your job, what is your income, your family size, where do you live, et cetera, et cetera. And it will also ask you for what's your balance on your loans, things like that. And they will give you the simulator will spit back out to you some different options that you have. So you are going to want to, so that's the personal info and loan information. When you're figuring out your best repayment strategy, you should have all of that stuff with you, or at least know it, to use that loan simulator. You're also personally going to want to figure out what your repayment goal is. There's usually three specific, mostly three buckets. People want to pay it off as fast as possible. People want a lower monthly payment, or some people want to pay the lowest total over time. So you have to decide what's most important to you and what works for your individual budget.
And Nikki, since we mentioned the loan simulator, the last time that we used it, we checked it a few days ago, and it was functional, but it spits out a alert that whatever the result is may not be accurate. And so we usually provide that link when we're talking about this, but because of the lack of clarity around its functionality, we just want to put that disclaimer out about the loan simulator. And you can plug in information about private loans and institutional loans and, calculate some options, but you may want to do the calculations yourself as to what your goal is. Like if you want to pay it off as soon as possible, considering your income or your anticipated income and your other expenses, you may want to calculate that monthly payment yourself in order to pay it off as fast as possible, considering your other responsibilities. So just keep that in mind if you do use the loan simulator. Again, like Nikki said, it's just an idea. And especially if you are on federal loans, you might have something spit out where it tells you to apply for SAVE, and that's no longer an option. Is that helpful to add on, Nikki?
Yes. So basically, in essence, the loan simulator is still there, but it is just that, a simulator. What it spits out to you may not be exact, particularly in the circumstances as the Department of Education continues to adjust to the court rulings.
Yes.
All right. Consolidation versus refinancing. Probably both you hear those words a lot. So a direct consolidation loan, that the only loans that are eligible are federal loans. So this is for people who may have, you know, loans for federal or for undergrad, grad, PhD, whatever it is. And instead of paying each one of those separate, you want to consolidate them, which means you want to merge them all together. So you have one payment. That is, so first I'm going to talk about that consolidation. So it does not guarantee you any sort of lower interest rate. The rate is fixed, meaning there's a weighted average, and they will, before you agree to that, they will let you know what your interest rate is. There's no credit check required. You're not going to necessarily save money long term, but it might help you lower your monthly payments. Yes, income driven repayment plans. Yes, if you that income based repayment plan, that one that's left, maybe. For public service loan forgiveness, yes, you could still access the public service loan forgiveness with a consolidation loan. Eligible to maintain federal Perkins loans forgiveness, that's no. And that is, again, very specific if you have a federal Perkins loan. So that's consolidation. On the other side, you have private refinancing of loans. Sometimes you could do it with federal loans, but by and large, it is private. It is possible to have a lower interest rate when you refinance. It could be a variable interest rate. It could be a fixed interest rate, and it is based on your credit and your credit score. So that is something to keep in mind with your private loans. A credit check is required during refinancing. Will you save money? Probably, particularly if you receive a lower interest rate. But again, private loans are not eligible for public service loan forgiveness, any sort of income-driven repayment plan, anything like that. So consolidation is really for federal loans. Refinancing is for your private loans.
I would just like to add on, if you are a high wage earner, a high income earner, and you have excellent credit, private loan actually might be better than a direct loan for you. The main benefit of a direct consolidation loan is that you maintain federal benefits like eligibility for deferment, forbearance, possibly public service loan forgiveness, transferring into IBR for eventual cancellation. So the things that you need to consider for if a consolidation or refinancing is better for you depends on your individual situation. I just need to emphasize the individuality of all of those things. Oh, also disability discharge. That's only going to be eligible for direct consolidation loan if you have federal loans. Thank you.
All right. So there are a few, as we have mentioned with the repayment plans, there are also a few direct consolidation concerns. One is that currently, again, as of like 11 o'clock this morning, the online application for a direct consolidation loan is completely unavailable. You may be able to snail mail a paper application and drop it off. However, we personally recommend that if that is still available and that's what you decide to do, that you send it certified mail, so that way you have a record that you sent it in and that they received it. Unfortunately, there is no clarity regarding direct consolidation loan applications. If you had already put in that application, we do not know currently if they are still being processed or not. We wish we had more clarity for you, but at this moment in time, we do not. So keep an eye out on federal student on the FSA website. Sorry. All right. Qualifying for loan forgiveness. Let's go through some of that. All right. So what can you do? There are 3 types of loan forgiveness. There's cancellation, which is the income-based repayment loan cancellation, public service loan forgiveness, teacher loan forgiveness, the law school loan repayment assistance and National Health Service Corps. Those are for borrowers entering very specific fields, similar to the teacher loan forgiveness problem. So like, think if you're a public school teacher, you're going into law school, National Health Service Corps, those are going to be very specific programs based on what your profession is. I want to talk for a second about the teacher loan forgiveness, because it gets a little confusing, because teachers can also apply for the public service loan forgiveness program. If you are a teacher, the teacher loan forgiveness was a program that was designed to encourage teachers to teach in lower income areas and under Title I. And so those are for very specific teachers that are teaching in very specific areas. Public service loan forgiveness is for any public servant. So as long as you are working, and so that could be government, at one of the state universities, at a K through 12 public school, if you are a firefighter or a police officer, all those public service can be part of a public service loan forgiveness. The income-based repayment, that is usually after 10 years of paying using that particular repayment plan, then the rest of your loan is canceled. As for this slide, just as an FYI, the year that if you get the rest of your loan canceled or forgiven, there is a chance that you need to pay income tax on the amount that is canceled. That varies state by state. That's a state by state case. In Illinois, they had paused it for a while, but I'm not sure right now. All right, so if you're seeking any type of loan forgiveness, you need to first know that what you're eligible for. Stay organized. If Andrew and I could stress anything, it's to stay organized. Make sure you know how many payment counts you have. Understand how to maximize forgiveness with like income-based repayment. Submit the required paperwork annually, or if there's a change in your situation. So if you get a new job and your income changes or whatever it might be, it is so much easier for any of these programs to keep it up yearly, rather than trying to backtrack and find all the stuff that you need to after you're at like year 10. That's where a lot of hiccups happen. So the biggest piece of advice we could give is to stay organized. Put a yearly reminder in your phone, like every March, you recertify your income-based repayment, you put in where you're working, etc. Or just, hey, review your student loan. Just the more you stay organized up front, the easier this is long term. All right, so public service loan forgiveness, PSLF. Again, very specific. So there are sorry, I'm not laughing. It's just, there's so much of this that we're like, this is how it should. Okay. So public service loan forgiveness is you enter into a public service career. Like I was saying before, any public service career, you make 120 qualifying payments. 120 qualifying payments, in other words, is 10 years. You pay on that for 10 years. You need to have only direct loans. You have to be in qualifying repayment plans, which again, now is only the income-based repayment. And you have to work for the qualifying employer. At that point, and all along those 10 years, you're keeping up with your paperwork, you're certifying that you're still in public service, then the rest of your balance will be forgiven. Historically, that forgiveness is then not taxable. We don't know what will happen in the future. This is, again, a program that is created by Congress, so it cannot just go away under like an executive order or anything like that. However, it is hard right now on the website because of all of the court cases, and all these things are different, are paused, etc. That like, it is hard to do this online right now, if not impossible. So just keep an eye on that. It's in the chat. There's an entire student aid section that's dedicated to the public service loan forgiveness. They have their own sort of simulator and everything. But as we said, all processing of the income driven repayment applications, even those that were submitted before the court ruling. So let's say you're like, well, I'm good because I did this. They have all been suspended. So if you are currently in a if you're like, I was doing this public service loan forgiveness and I was on a SAVE plan, that plan was automatically moved from SAVE and your loan was put into forbearance. And what that means is, as long as your loan is in forbearance, none of that time that you are spending in public service will count towards your loan forgiveness. So if public service loan forgiveness is something that you're pursuing or interested in, you are going to want to go back and maybe just keep a very close eye on this. Andrew, am I missing anything there?
There's a comment in the chat that I think we should address, because right now there are a lot of people in administrative forbearance and they are not making progress towards their public service loan forgiveness. However, during the COVID pause on repayment, all of those months, even if you weren't making payments, counted towards public service loan forgiveness. So those, as far as we understand, still count. Those months during COVID where there was the payment pause nationally still count towards public service loan forgiveness, but the current pause does not. I think that's like as clear as we can make it for now. I mean, things could change in the future, but that's our understanding of it right now. And I know there's a bunch of educators that are here with us too, that are probably having similar. We don't know what to inform our borrowers about. So hopefully the, yes, someone mentioned clear as mud. That's pretty much how we feel about public service loan forgiveness and income driven repayment right now. I don't know if I helped or hurt with my additions.
No, you're good, Andrea.
Okay.
All right, so this is a little flow chart. And again, we're going to send slides that you can look at closely, but kind of lets you know, will public service loan forgiveness potentially work for you? And it kind of starts with, you know, it gives you a little flow chart that makes you think about your career path and what you would need to do. Like, do you have federal direct loans? Do you have, you know, are you employed by a qualifying public service organization? Do you plan to stay in the public service for the duration of your repayment. It's all kind of, it will help you kind of just get those thoughts, I think, organized.
I think it's my turn.
It is your turn.
All right, so let's talk about what you need to consider when you're making a plan to deal with student loan debt. So we really need to emphasize here the consequences of default. The reason why you need a plan is so you can avoid default. And some of the things that happen with default is, and this happens after you've been delinquent for many, many days, like 9 months. I think it's 240 days of being delinquent past due. And so once you hit that threshold, that 9-month threshold or whatever, the entire balance and interest is due immediately. You also will lose access to federal student aid and loan benefits. That includes deferment and forbearance, the ability to choose a repayment plan. So not just the income-driven plans, but also graduated repayment or extended repayment. So that's really important to keep in mind when you're thinking about default and its consequences. Student loan default can stay on credit reports indefinitely. Recently, there was a lot done to remove those defaults from credit reports, but that is no longer the case. There's not the protection there that there was some reversal of defaults on credit reports, but you can also risk wage garnishments, tax refunds, and federal benefits being withheld in other areas of your life. So you really want to avoid default. However, if you do end up defaulting, you can rehabilitate your loan. And so if you do a rehabilitation, you can have a student loan default removed from your credit history or reports, but it will stay if you consolidate out of default. So knowing what your options are, if you get into a point where unfortunately you've reached default, is really helpful for understanding longer term costs of how you navigate out of that situation. So one of the tools or two of the tools that you can have to avoid default is understanding deferment and forbearance, which we've thrown out a lot already during this webinar. So these are two tools to use for temporary repayment relief. So deferment is really a borrower's right if you're eligible, and forbearance is kind of at the servicer's discretion. So right now we say administrative forbearance for everyone that was automatically moved, that you were in a save plan, and when the litigation challenges, the legislative challenges went into place, you were automatically put into administrative forbearance. That was the servicer's discretion. So in these situations, interest often still accrues. If you have subsidized loans, no interest will accrue on while you're in deferment. However, if you have unsubsidized loans, interest can accrue while you're in deferment. So borrowers in some income-driven repayment plans were obviously placed in interest-free administrative forbearance last year because of all the legislative challenges that we talked about, as well as some loans being moved to different servicers or back to the Department of Education. There were a lot of reasons why borrowers were being placed in administrative forbearance. And that was happening primarily last summer. If you need to request a deferment or maybe a forbearance, you have to work with your servicer. That's why it's so important to know who your servicers are. A deferment is most commonly used for in-school status. So if you're in school, deferment might have automatically been placed for you. If you're in economic hardship, military service, unemployed, or cancer treatment, like we mentioned earlier. A forbearance is commonly used for financial hardship when deferment is not an option, or then there's an administrative reason why they have to put it in forbearance while they make changes to how they're servicing your loans or what the options are for loans. So you also want to think about how will you repay your loans in order to make this plan. While you're in school, you want to try to keep your debt lower than your anticipated first year salary, which is sometimes difficult, especially if you've changed your mind a couple times, or if you're not as familiar with the starting salaries for your degree field, or you don't know what job openings are going to be available when you graduate. So this can be a difficult thing. It's a good rule of thumb, but we understand not everything works out like we idealize. You also want to build your skills so you can start budgeting now if you're in school or wherever you are in your life, so it can make transitions easier. When you know what your spending trends are, or when there's fluctuations, it's a lot easier to make changes to your budget and financial priorities. You also want to consider your cost of living differences if you relocate. There's a lot of people that are in transition right now. And so looking at not just salaries that you're being offered, but the cost of living differences for the locations you're looking at relocating to can be helpful for making a plan for both repaying your loans, but as well as accomplishing other goals that you might have. You also want to consider what your career is and what your intentions are with that career. Again, a lot of people are in transition here with careers as well, but public service loan forgiveness is a 10-year commitment. It's 10 years of your life working in public service, typically for lower wages, which is why income-driven repayment is such an important aspect of that decision-making process. For example, I've worked in public service over 15 years, almost 15 years, and I had loans, but my loans were low enough where public service loan forgiveness wasn't an option for me. I didn't have to think about that. But it's something that a lot of people do have to think about in their career trajectory and what they want to do long term. And we have to acknowledge that things change. So if you get into a position where you're making less than you anticipated, or things aren't how you thought they were going to be, or again, transitions are happening all the time, don't forget about deferment, forbearance, and hopefully in the future, income-based repayment as an option for repaying your loans. Because these are tools that you can use, especially for federal loans, but you can also negotiate what's going on if you talk proactively to your private servicers as well. So there's a lot of options, but it's overwhelming to think about what those options are, how to navigate choices sometimes. So this is kind of why we wanted to address this aspect. All right, so if you are in a position where your goal is to expedite loan payoff, you obviously want to limit what you spend while you're in school. I think a lot of people are currently on the call, maybe past that point, but for anyone that might be listening to this later and you're in school, limit what you spend while you're in school. Use roommates. Try to think about your flexible spending and what that means for long-term costs, especially if you're borrowing to pay for school. You might consider biweekly student loan payments. So essentially you're making loan payments every 2 weeks instead of once a month. And by doing that, you typically make an additional payment every year because of how biweekly versus monthly payments work out. You also want to sign up for ACH, or automatic payments. If you have federal loans, you'll get a 0.25% interest discount if you sign up for ACH, if you're in that situation. If you're paying more than the minimum, you want to apply the additional amount directly to the principal and use either the debt snowball or waterfall method if you have multiple loans to expedite your loan payoff. You also want to pay down the principal while payments are suspended, if that's the case for you. So if you're not going to be seeking public service loan forgiveness or cancellation, and you're in a position where you can make payments and you have your loans in administrative forbearance, then it'd be good to pay down the principal while you can. Again, right now, a lot of people that don't have subsidized loans, any unsubsidized loans, are accruing interest. So even making interest only payments on some of those, depending on your long-term intentions, can be helpful. So the other thing to consider is paying more than the minimum. So if we had a almost $27,000 loan that has an interest rate of 3.9%, our minimum monthly payment on the standard plan, and that's the default plan that lasts for 10 years, is $272 a month. If we made an extra monthly payment of $50, we would have an interest savings over that 10-year period of $1,077. So keep that in mind and how it can reduce your overall costs of total paid towards a loan when you're thinking about expediting loan payoff or paying the lowest over time. Yeah, even little amounts towards the principal can add up. All right. We mentioned loan servicers a lot. You want to make sure that you contact your loan servicer to make payments on your student loans, request changes to your payment plan, especially once that becomes more available. Apply for student loan forgiveness if that becomes available. You can also use it for applying for loan cancellation. Again, the only plan that we're aware of that will be eligible for cancellation after so many years of payments. I believe, is it 20 or 25 years? I keep forgetting. Nikki, do you remember?
Um, no. Because it depended on also the income driven repayment plan you were on.
Right. So
And
IBR was
so,
either 20 or 25, and I can't remember which
yeah,
one it was.
but I can't remember. I want to say it's 25, but I don't want to be quoted on that.
Yeah. So don't quote us, look it up, but it's at least 20 years. You also want to work with your loan servicer to request a deferment or forbearance if you don't currently have one, or to work with them to discharge loans due to permanent disability. So loan servicers change all the time. They like to change their names. These are the ones that are currently available as of March 3rd, March 6th. What's today? 2025. If you are being hounded by a servicer that isn't on this list, you might have private loans or FFEL loans that are privately held. So that was one of the complicated aspects of Family Federal Education Loans. Even though it was a federal program, some of the lenders were private lenders, and some of the lending came from the U.S. Department of Education. So some of them are federally held. And so if you don't understand what type of loan you have and who your servicer is, it makes it difficult to determine what your options are for repayment. All right, so another thing we want to do is remind you to know your rights. You do not have to pay for help on student loan issues, especially if you're in repayment. So if someone is going to charge you to get you into an income-driven repayment plan, they're not your servicer. They're charging you to fill out some paperwork to contact your servicer. You should not have to pay for any help on student loan issues if you are currently a federal loan borrower. You also want to report bad loan servicers to either the Federal Student Aid or your state's attorneys general. You also can report student loan debt relief scams, of which there are plenty every single year, to the Federal Trade Commission, the FTC. And obviously, we're based in Illinois. And so for anyone that's in Illinois, you want to remember there's a student loan bill of rights. So if you are a student loan borrower who is in Illinois, your residency is in Illinois, you have the right to clear and accurate loan information, prompt and accurate handling of payments. Servicers are required to explain loan options to you as a borrower. You also have the right to a payment history information on request, and you have the right to a timely dispute resolution and appeal. And if you have questions about that, or you're concerned about what your loan servicers are doing, we put the IDFPR link in the chat to help you with that. All right, so if you need to file a complaint for any of the other things that I mentioned, you want to identify what the issue is. You want to record all the facts, names, dates, etc., who you were on the phone with, what organization that they work with or claim to work with. You want to collect documentation around that and submit to the appropriate agency. So for federal loans, you can submit federal student aid complaints to the feedback center. For scams and fraud, you can report those to the Federal Trade Commission, and they do all kinds of scams and fraud, not just those about student loans. And then you can also contact the Illinois Attorney General for anything related to violations of the Student Loan Borrower Bill of Rights or issues that you're seeing as an Illinois resident for student loan servicing. So in summary, it's important to know what you owe, who you owe, your servicers, have a plan, know your rights, and leverage the tools available to you, which I know are limited right now, but hopefully we've given you some background information and some paths forward, depending on where you are in your student loan management journey. There are a lot of helpful sites and tools out there. Department of Education Student Aid website has a lot of information. It's not being updated very quickly, so make sure to double check anything with more recent news about whatever you're looking at. The loan simulator can be a good tool to use, so check that out if that's something that you are trying to figure out what repayment option or strategy is best for your future. There's also the Illinois State Attorney General student lending page. If you're in Illinois, knowing your rights is important. And then the Student Money Management Center, where I'm from, has a student loan web page that provides more information, because we went over a lot of different terms, a lot of different concepts, and it can be difficult to keep them straight. And we try to keep that particular page updated with new information once it becomes available and stabilized a little bit. So our next webinar is Psychology of Money, Stages of Change, which is next week. It might be something you look forward to after this stressful student loan webinar. So that will be on Thursday, March 13th at 12 p.m. We also are going to do a Money Stress and Bad Habits webinar on Thursday, April 3rd, again at noon. If you want to watch any of our previous webinars, you can check that out on YouTube. Last year, Nikki and I did a whole 8 months worth of mini updates on student loans. I've not taken any of those down. Some of the information is outdated, but it goes over certain concepts that we covered here in a much more depth that might be helpful for you. We also collaborate with lots of other people across the state and nation on these different Get Savvy webinar series. And we will stick around for questions. I know there were some questions in the chat. I saw them briefly as we were talking, but couldn't quite address them. I do want to emphasize, we are not financial planners. We cannot provide financial advice. So keep that in mind. I know that there were some people looking for support for finding and picking out a loan. We can't do that, but we'll do our best to explain any questions that were still lingering if you have them, and put them in the chat. So Kwabena or Richard, I know you were monitoring the chat pretty well for us. Is there any questions that you think we should address first or were asked more frequently?
No, Andrea.
Okay.
I think most of the questions were addressed through the conversations.
Okay.
All right. One just came up. Do loan servicers automatically combine your direct loans into one payment? No.
This one's complicated, actually.
Yeah.
So if you go to like multiple schools and get loans dispersed at multiple different schools, sometimes what will happen is all of your federal loans will go to different servicers. And so in that case, you're going to have to pay different servicers. They typically try to put them all to the same servicer. And in that case, you do make one payment for all of the dispersed loans if it's all at one servicer. What's complicated is when it goes to multiple servicers. And that's also where consolidation comes into play. So if you are having trouble managing loans at multiple different servicers, or maybe you had a FFEL loan and it's federally held, but you're paying one servicer for the FFEL loan and another servicer for direct loans that you were dispersed in grad school or whatever, then you can consolidate. Unfortunately, right now, the consolidation application has been taken down. All right, that one was clear.
How to track the amount of student loans when the combined loan have different interest rates. So if you combine the loan, do you mean if you're meaning in a direct consolidation loan, they will take both of your loans and it'll be like an average of your interest rates.
Yeah, it's a weighted average. But even if you don't have it consolidated into a direct consolidation loan, so what they're referring to, I think, Nikki, is when you have different disbursements while you're in school, it will list in your loan servicer them as separate because sometimes they'll have different interest rates. And so even when they're at the same servicer, the interest that you pay is going to be a weighted average of all of those dispersed loans, even they're all direct loans. And that's what you'll pay. And I know it's hard to keep track of, but if they're all at the same servicer, what you're going to keep track of is that weighted average. And you can calculate the weighted average. There's lots of calculators out there that help you. And when we say weighted average, what that means is based on the total amount of debt that you owe, they're going to make the weight of the interest rate correlated with the most amount, the highest balance loan is going to make up the most amount of what the combined total interest rate is. It's hard for me to explain it verbally without a visual thing. And so maybe we need to do like a separate mini video just on understanding how the weighted average interest rates go. But I think as far as tracking, if you're still in school, you want to track all of the loans that have been dispersed, their amounts, and their interest rates. Just keep a log of them so that when they go to a servicer or when you start paying, you know that they're all captured. Hopefully that also helped. It gets complicated when we're trying to determine the difference between, all of your dispersed loans that are direct went to the same servicer, and so it looks different there compared to consolidation loans.
Right. So another question, are there any additional cons to paying your loans while in deferment besides those payments not counting towards any repayment plans?
I can't think of any. If
Yeah.
if you're not concerned about forgiveness or cancellation, I mean, I can't think of any unless you're trying to use your buying power for something other than paying your loans. That's a good question for a financial planner.
But in general, it's not like you're gonna lose X, Y, and Z. You might like,
Yeah.
yeah.
It's not a tangible across the board pros and cons versus if you are actually seeking cancellation or public service loan forgiveness. There are definite cons if you're seeking that.
Is it possible to pay the loans that have higher interests when the loan is combined?
That one is more complicated because all of the servicers are different. And they're going to apply it based on the policies that are prevalent at that servicer. It might be easier to do actually with private loans compared to federal loans. You can always request. That's why talking to your servicer is helpful.
All
Is-
right.
Does anyone have any easy questions that you need clarified? All right. So, Nikki, do you have anything to add? I feel like I stole the show there at the end.
No, it's all good. We're a team. All good. We apologize. We know some of this is super confusing and it changes and it's hard, but we hope that we were able to at least provide a little bit of help and clarity.
Absolutely. And if you think of any questions later that you're like, I need an answer to this one, you can email studentmoney@uillinois.edu and we will do our best to get you an answer or get you references so that you can come up with your own answer if it's just too close over the line to advice from education. We'll do our best to help you though with that question. But I'm sure everyone is either hungry or stressed out and needs to go get a cookie or an ice cream. I'm feeling like maybe a donut's in my future. But if you are welcome to log off and have a better day than this hour and 20 minutes has been. And we will send the recording to everyone that registered once we've appropriately captioned and packaged everything together, and we'll email you. So thank you again for joining us, and I hope that it goes up from here.